Good morning, everyone, and welcome to the very first webinar of 2024 here with us at InvestSMART. My name is Mitchell Snedden. I'm the Head of Portfolio Services here at InvestSMART. And many of you I would have actually spoken with in the past. So welcome and thank you for joining us, hopefully still on your holiday break. And so today's webinar, what we're going to be covering off is a bit of a roadmap for 2024. Now, so what we'll be really focusing on is what your investment goals are for 2024. We'll be focusing on how you can set up and structure your account, or just maybe double check that your account is structured in the right way to help you achieve those investment goals. Now, this is an interactive session. Please feel free to use the comment section to send through any questions you might have about your portfolio, the InvestSMART process, the market as a whole. I will love to answer as many of those questions as we go along. So let's make it as informative for you guys who have joined us today as we possibly can. So the very first slide of all of our presentations is our disclaimer. So we're going to be talking about investing. We're going to be talking about investment products. We're going to be talking about the market. None of this is personal or specific advice because I don't know your personal circumstances, and we always recommend going out and seeking assistance from a financial advisor if you do believe you need to do so. So this is general in nature. And I won't be able to answer any personal or specific questions of that kind. So let's jump into our first slide. Just recapping the major themes of 2023 that you would have definitely been aware of. I can't think of too many years where finances and markets have dominated news headlines, mainstream news headlines, as much as 2023. Interest rates were at the top of absolutely everybody's mind, whether or not you're a homeowner with a mortgage, if you're, say, a retiree with a healthy amount of cash in term deposits, you would have been enjoying that. Even if you're renting a property as well, you would have noticed, of course, rent increases going on, et cetera, all driven through interest rates. So we started the year of 2023 with the RBA cash rate of 3.1%, and we ended up finishing the year at 4.35. So that's after a historic 5 interest rate rises. So that certainly dominated the headlines for 2023 for investors and non-investors alike. I think if we take a step back and look at what the result of this for markets were, we actually saw the Australian stock market have an incredibly strong year and finish December at all-time highs. So the much talked about things like the mortgage cliff and whatnot was certainly didn't really seem to have too much of an impact on the stock market. Of course, there's definitely individuals out there that would have certainly experienced that, but all the fear and rhetoric that was built in around that did not seem to sway markets. Of course, then we had the cost of living and property prices. This was a flow-on effect from interest rate pressures. And it's certainly more created a big social divide as well, but between the people that it was affecting. Certainly a lot of rhetoric between boomers and the younger generations. We also saw, unfortunately, a lot of geopolitical conflict continue in 2023. Of course, we had the Russia and the Ukraine continue on, and then we also had tensions, of course, boil over in the Middle East. Then on a tech front, we had probably the biggest theme in investing for 2023 was the boom in AI. Now, and the rush for people to wanting to play that AI theme. So we'll touch upon that in a little bit. That certainly does seem to be one of the trends that is actually sticking around. So I've been investing in markets for about 15 years now, in this type of role, and I've seen a lot of trends come on and boom and bust. I remember 3D printing. I do remember companies absolutely going through the roof on 3D printing. I remember medical marijuana when that came around. Another more recent one was when blockchain was mainstream news, and you saw every second ASX company trying to jam blockchain into their investor presentations, including actually the ASX. Was talking about a blockchain replacing the chess system, which they've subsequently scrapped. But AI does seem to be one of those themes that will stick around. I know I've actually used Google Bard almost daily just to ask it little questions here and there. And there's certainly that is going to have an impact on business and going to have an impact on markets, and which you've seen through the especially the US market. Some very big winners there with NVIDIA, but of course Google and Microsoft as well. So they are the, I guess, there probably are a few other smaller themes, but they were the largest ones that caught my attention in 2023. How much of those actually had an impact on our investing? I would here at InvestSMART, actually none of them. So we'll go into that and the reasons for that as well. So let's jump forward. Now let's have a look at the actual return asset class returns across the various ETFs that we use here in our diversified portfolios. You see cash had a really good year. It was essentially a really good year for almost every single asset class. If you look back at these asset classes last year, for the last 12 months to December, the only positive asset class across that time frame was actually cash. The rest had a negative return. But you see here, cash, we use the Beta Shares Australian High Interest Cash ETF. Essentially, what that goes out there and does is invests in a rolling term, in a series of term deposits. So instead of you having to hunt down the best term deposits, this ETF actually does that for you, and that's why we use it. So you can see it returned 4%. Over the last 12 months. Even fixed interest and bonds, which had an absolutely shocking 2022, bounced back to 4.96% return for the last 12 months. Infrastructure is still really struggling, and that's a direct correlation with the increase in interest rates. Australian shares really was difficult to predict that Australian shares. I don't think anyone would have predicted, if we look back this time last year, that Australian would be sitting here saying that the ASX 200 returned over 12% for the last 12 months. And property, Australian property through the Vanguard Australian Property Securities ETF returned 16.62%. So that's looking at commercial property, the office blocks, things like that. And then global bonds, we saw a return there of 5% for the last 12 months. And this goes back to one of those big themes that we saw in 2023 of AI driving the returns here with streaks ahead of every other asset class was international equities. It returned 23%. The Vanguard index, international shares index. So essentially the really big key drivers of that, and that's why I hark back to the key themes that we were looking at there. You saw Microsoft, NVIDIA, Google, and Amazon, the like, which are all beneficiaries of AI. And you've seen those tech companies really, really race away in 2023. And if you are sitting there and you're dramatically, say, an investor who's dramatically overweight Australian shares at the detriment to international shares, your own returns wouldn't be looking as healthy if you did not have those that exposure to international shares. That's something that we have been. I know last year we were, and or prior years as well, really hammering on about is the exposure to international equities and the importance of it in your portfolio. It has a role to play in all portfolios through from conservative to high growth, and that role is growth. Of course, a lot of Australian investors don't have as much, or some people don't have any exposure to international equities, and the reason they use for that is because of the lack of franking credits available on the international equities. But you can see the difference in returns here, especially say if we even look actually back over say 5-year returns. Franking credits aren't making up that gap to those other asset classes. So for investors who were underweight international equities over the last 12 months, they've certainly felt that lack of exposure. I'm just going to get rid of myself here from the screen so I'm not cutting off some of the presentation. So here's a quick look at these numbers. I just got them fresh this morning, so they're not actually up on the website yet. These are the last 12-month returns, the latest returns to the end of 31st of December. So you can see a big turnaround across the conservative through to the high growth portfolio. Now, we do not like to put any weight on those 1-year returns. We do want people to focus on the 5-year numbers and the since inception numbers, because that's more indicative of what long-term investors are going to receive from these portfolios. The 1-year returns, they will fluctuate. Now, for newer investors with us, who the big important thing here is to get those long-term returns. You need to hold for the long term. So newer investors who are experiencing some big fluctuations with their portfolios as the markets ebb and flow in the short term, the main focus here is to continue to hold through those ups and downs, and that's how you will eventually receive those 3-year returns, 5-year returns, and those since inception returns in your portfolio. It's allowing time and compounding to do its work. Now, let's jump forward. So the major themes, what are they going to be for 2024? We don't know. More uncertainty is essentially the only theme that we can accurately predict. And I've got a great quote there from Burton Malkiel, who's an American economist, said, "Forecasting the market is like trying to nail jelly to a wall." So essentially, we do not sit here and try and predict market movements. We don't try and predict what the international markets are going to do, or Australian, or property, or bonds, etc. We build well-diversified portfolios in line with their risk profiles, and let those let those asset class returns do the rest of the work. So we are passive investors, and so we're not trying to forecast the market, because as our mate Burton there says, it's very difficult to do. It's almost impossible to do consistently. We might actually do it, and individual investors might be able to predict the market movements going forward correctly, once or twice. And that's actually quite dangerous, because people begin to believe they can do that in ongoing. So we don't even, our experience tells us not to even attempt to try and forecast it, but to believe in what all the data tells us that over the years, and to get a blend of asset classes in our portfolios and let those asset class returns do the rest of the work. Now, looking forward though, in 2024, more interest rate movements and interest rate speculation will definitely be high on the agenda. I believe most economists here in Australia anticipate interest rates to be starting to be cut and the consensus there is in, say, towards the back half of the year in, say, September. But of course, their guess is as good as yours. We don't really know, and the RBA will be focusing on what the data presents them to make those decisions. Of course, we've got a US election. That's always entertaining. Is it always useful or insightful for investing? We don't think so. You can actually go onto Vanguard's website and you can pull up they've got an interactive chart, and you can put up different prime ministers and presidency timeframes, and you can see how the stock market has done throughout those timeframes. Now, at the end of the day, what we actually see there is that an election doesn't actually, has generally speaking, no impact on market returns. So there'll be a lot of headlines, there'll be a lot of noise around it, but what it means for you as investors is actually very little. Of course, there'll be plenty of property price uncertainty. The cost of living pressures will continue on. So essentially, it's what we're anticipating is basically more of what we saw in 2023. Now, as I mentioned, we don't try and predict what's going to happen. We actually weed out this noise, and all of those headlines and whatnot are noise. And instead of predicting what's going to happen, we want to make your portfolio theme proof. And by that, I mean, when I say theme proof, I mean we try and get broad exposure to a range of different asset classes, to a range of different sectors. So say if, for example, AI does continue to run as an investment trend, you have exposure to that. You have exposure to that as part of our international equities component of the portfolio. And so you're going to enjoy those returns as well. Now, if, say, things like lithium, et cetera, have a bounce back, you have exposure to those asset classes as well in the diversified portfolios. So by having this broad range of asset classes and then hundreds, if not thousands, of investments within those asset classes, you're going to benefit from whatever theme comes your way. And if something does, say, if AI becomes a bit of a bust or fizzles out, like previous themes that I've mentioned, you're not going to be hurt or impacted as much by that, because you've got thousands of companies doing all different types of work in lots of different sectors, and so they're going to cushion that blow. Alrighty, so this presentation, we really want to talk about what you're trying to achieve. So essentially, what we see here on the client side of things at InvestSMART is the outcomes of different people, and those investment outcomes are really driven by their own actions. And so I've got here essentially a quick little checklist for people to have a look at. And number one is, do you have a plan, or is it time to review your investment plan? So take the time now, if you are on holidays, if you're got some time on your hands, maybe you are back at work and it's a little bit slow at the start of the year, review your investment plan. And so, because if you've got a good investment plan in place, it really does help you weather the storm or weather any uncertainty that is coming, because I've never not known a time in investments in markets when it's not been uncertain. There's always been something to worry about. So let's review what your goal is, and specifically, what is your time frame to achieve that goal? That time frame is something that's really important to us here at InvestSMART. And if you've ever spoken to us directly, if you've ever seen the previous webinar of ours, you'll know that we talk about time frames a lot, because the time frame will help you understand the risk profile and what portfolio you should be looking into. So as I said here, so your plan will include your purpose, your time frame, your contributions or withdrawal schedule, and if you're going to reinvest dividends or not, etc. And if you're uncertain about any of that, please just hit us up. We're really happy to have a chat about this. Now, secondly, once you've got your investment plan in mind, do you have the right portfolio? So this webinar is just for our professionally managed account investors. That's the only people who were invited to it. So that's what we want to speak about specifically here. Is do you have the right investment portfolio? Once you've determined your goal and the risk profile and the time frame for that goal, have a look at the time frame on our InvestSMART website of the portfolio that you've chosen, and compare that to, so each portfolio page has the recommended time frame against the portfolio name. So you'll see that there. High growth is 7+ years, and it scales back from there. Now think about your own investment goal, and does that time frame align with your with the portfolio you've chosen? If not, maybe reach out to us, have a quick chat. You can amend that portfolio easily online, and we'll and you can switch to another one. You might be going from conservative to growth or whatnot, depending on what your investment goal is. Now, next is your account settings. So once you've got the right portfolio, let's make sure you've got the right account settings to help you achieve that goal. Now, if that goal is growth, I'd go into the investment preferences section, okay, and just check, do you want a regular contribution plan turn on? This is where every single month we will direct debit your bank account and add funds to your investment account. So if you're trying to grow your wealth, this is an automated tool to help you do that, to help you set and forget. And then dividends being reinvested. So there is a button in that investment preference section, and that button is called the income sweep. Now, if you're wanting to grow your wealth, if you're wanting those dividends to come into your portfolio as cash and be reinvested into your account, then you want that income sweep turned off. Okay, you don't want that turned on. So for people who successfully use our accounts to grow their wealth, they have regular savings coming in, and that's either via a regular contribution plan, or they're transferring in funds on an ad hoc basis via the BPay details that you've got provided, and they are reinvesting their dividends. Okay, so go to your investment preference section if you are growing your wealth, and just make sure that you've got those things turned on. As well, make sure you know the BPay details associated with your account. There is a button called Add Funds. That Add Funds button, as you go through there, that'll provide you with the BPay details to your account. Now, if you're looking to maintain your wealth, you might be retired and you're looking to use this as a source of income for your lifestyle, go into that investment preference section again and have a look and check it to see if the income sweep is turned on or off. So you may, if you want to use the dividends that are coming from your account to fund your lifestyle, we recommend turning on the income sweep. Now, there is a setting for a regular withdrawal plan, so you may wish to say have a few $100 or $1,000 a month or whatever it is coming out of your account to fund your lifestyle. So have a look at that setting. And people do often use the income sweep, the regular withdrawal plan, and even the ad hoc withdrawals, all in conjunction with each other to manage their income requirements. Now, finally, what is your plan for when the ups and downs of the market hit? Now, this is really, really important because understanding the way you feel when the different market gyrations come about is probably the most important, the most critical thing for you as an investor. So when you're investing in a managed portfolio or ETFs, etc., your one job as an investor is to hold. That is it. Your one job is just to hold through thick and thin, and to maintain a calm, rational approach. So by having your investment plan in place, and say if you're saving, you're going to be adding maybe $200 or $300 a month to your account. do that through thick and thin. Even if the market's down, it's great. You're actually buying more. When the market's high, that's fine. So what you want to avoid is feeling overconfident when the market's high. So if say things are really hitting all-time highs, it does feel good to look at your account and to look at a high account balance. What you want to avoid doing, though, is extrapolating that feeling and go, well, I might actually add a bit more this month. Just stick to your plan. And conversely, you might not feel like adding to your account when the market's low. The common thing is, oh, well, it's not doing very well, is it? But it's just the natural market fluctuations. So try and avoid those feelings and become robotic about your investing and savings approach. It's easier said than done. I've been doing this, as I said, for 15 years, and I still, feel good when I look at my portfolio and it's nice and high, and I feel like maybe I've done something wrong when it's been impacted by markets. But I've know enough now to resist the urge to actually do anything or to change anything. Now, if you're ever feeling like you need a helping hand or you just need to talk to someone, please do reach out to me and the team. We're really, really happy to have a chat, be it online, be it via email, be it via the phone. We're here to help, especially with that. If you just want to, make sure that you've done the right thing. Alrighty, so what I've got here is some case studies about what not to do with your InvestSMART portfolio. Okay, so this case study number one, we call it the commitment phobe. This is actually, believe it or not, a real account. All these studies come from real accounts. And so if your performance chart looks like this, it means you've been chopping and changing. You've been pulling out funds, adding funds, changing the portfolio that you're investing in. We've got it here saying more changes than Seinfeld had girlfriends. So you can see here, essentially, this person has cost themselves a lot of money in transaction costs and their portfolio's gone nowhere. Okay, they're their own worst enemy. If I was to pull up the inverse of this, and we do have some examples, where people just either invest at the start and make zero changes, then the blue line streaks away from the grey line. If they invest and then just have regular contributions coming in, then it just looks like a nice little step ladder, a nice little staircase, I should say, going up over the long term. You really want to avoid being this person that goes back to having an investment plan and knowing why you're investing and it being in the right portfolio from day one. Or if you're not in the right portfolio from day one, understanding that and making the change. Alrighty, so the second case study, and I really apologize if this is too small, but this is having the wrong time frame and being in the wrong portfolio associated with that time frame. So, for example, say you are, just because you're young doesn't mean you're always naturally high growth. Just because you're maybe elderly doesn't naturally mean you're always conservative. And by that, it's about the time frame. So say a young couple might be saving for a house, a home deposit, and they might be just a handful of years, 2, 3, 4 years off achieving that goal. Just because they're young, they should not be in a high growth portfolio. In that instance, they would be better off in a balanced or conservative portfolio, because the last thing that they want is when they come up to achieving their goal or reaching that savings target is for the market to correct and have maybe a 10%, 5% decline. All of a sudden, they might be 20 grand short of their savings goal, and they've been out there house hunting and they have to push that back. So that's why time frame and the risk profile really, really important. And conversely, say a retired couple doesn't necessarily mean all of their accounts should be in conservative, because they've got to think about funding their future lifestyle as well. And so they need a growth component to their portfolio. And so depending on the role that InvestSmart's playing for them, a growth or even a high growth portfolio could be could be on the cards for them. Now, finally, the last, and if let me know if your portfolio looks like this when you jump into your summary page. This is another common mistake we see people make, is they want diversification, and so they actually get a bit of every single portfolio. This does not help with your diversification. The conservative, the balanced, the growth, the high growth portfolio all hold the same assets, and they hold those assets just in different weights. So by having most people, 8 out of 10 people with us, it would be appropriate for them to have just the one portfolio in their account. Okay, just because you can hold multiple doesn't always mean you should. There are instances where it makes sense for some people to hold multiple portfolios in the one account. Those instances would be where you have different goals. You might have a goal, a really short-term goal, and you might have a long-term goal, and you're contributing differently to both of those. That's perfectly fine. You might be using, and I've got an article linked to this, if you are retired, you might be using a bucket investment approach or a bucket investment strategy where you have multiple buckets for different time frames. And so essentially how that works is you've got a here and now for your current spending, which you would hold in cash. I wouldn't say that you need to use InvestSMART for that. You're probably more than capable of managing a cash account yourself. But then there's a medium term and a longer term bucket. And so they go up the risk scale. So the here and now bucket's cash. The medium term might be, say, a conservative or balanced, and that's for topping up that cash account. And then the longer term one would be growth or high growth to fund future needs. That's an instance where you would have multiple portfolios in your InvestSMART account, but certainly not for what you want to avoid is diversification for the sake of diversification. As I said, you're not getting a wider spread of assets by doing this. So if your account looks like this, please get in touch with us. We'd love to have a chat with you. This brings me to my top tips for 2024. Now, for people who are hoping to get into the weeds with macro and where the market's going and things like that on our webinars, it's not what we're about. We're not going to do that. We're about long-term systematic saving and investing or investing and providing for your income needs. And market news and macroeconomic events and things like that are just 100% out of our control and out of your control. So we focus on what we can control. And that's for you guys. It's the costs associated with us. We can control the diversification in your portfolios. We can't control the macroeconomic events. And we know that if we try and forecast them and predict them and point your portfolios in specific directions to adjust for those, we're not going to get them right all the time. And when we get them wrong, they're going to have a really detrimental effect to your portfolio. So we avoid reacting to market news, and I suggest that investors with us do the same as well. The news and opinions I've got here are not designed to make you a better investor. There's many ways that people profit from markets, and it's not by being a market participant. They can profit from it from clicks and from advertising, and then brokers can profit from it from transaction costs. So you do not want to be these people are not out there to help you and become better investors. So the best thing to do is to avoid it. One thing that is useful, though, to using what I use the news for, is when I see the headlines of billions of dollars wiped off markets today, you will see those headlines all the time. They never tell you when billions of dollars are being put on, by the way. It's always billions of dollars wiped off. I actually use that to look back and see if it's a chance to actually invest more. Personally, we don't advocate market timing, but when I do hear that, I always look to see, well, do I have some spare cash lying around that I can get invested, because that to me is more of a buy signal than anything else. But I've trained myself to think like that over years and years and years and years of working in markets. The other tip that we have is do not interrupt your compounding unnecessarily. That's a great saying from the late Charlie Munger. So ensure that you have savings set aside for when bumps happen to you. You don't have to dip into your investments. But also, and this is the most common one that I've seen from people is throughout the years, is they see negative returns coming on the horizon, and they actually decide to jump out of the market. Now, that's well and good, but what they're doing there is crystallizing their capital gains, so they're costing themselves tax. But also they then have to they're on the sidelines with a big wad of cash, and they have to make the decision to when to jump back into the market. And I can assure you that is actually more paralyzing decision to then when it comes to actually getting out of the market. And so historically, what I've seen more often than not is people sitting on the sidelines. The market runs away. They anchor themselves to that point at which they sold out at, and then they say, oh geez, well, the market's too high now, I'm not going to get back in, and they forgo a lot of returns. So we really highly recommend just holding. That is the best thing you can do through these market fluctuations. Next, so stick to your plan. So don't add more in the good times, don't add less in the bad times. Just be robotic about it and just stick to that plan. And finally, keep learning about investing. So I know you pay us to manage your portfolio, but the more informed you are about ETFs and about our investment approach and whatnot, the more comfortable you'll become with long-term investing. So do you make use of us and our resources? Do reach out to us. Do ask us questions. Ask me questions here on this webinar as well, if you do have any. And because we are here to help you get the most out of your portfolio. And part of that means understanding the investments that you hold, understanding the market movements, and not jumping in and out and helping you make the right decisions. Now, finally, I've got a few article links here. How to Worry Better is a wonderful article written by John Addis. If you can't click on this and get those, please let me know and I can email them to you. But How to Worry Better is a wonderful article by John Addis. It's quite timeless, and he understands that people will never stop worrying about investment markets. So this is some tips from him on how to do it better. The top money tips for 2024, there's an article there. You'll see it in the insight section. Paul Clitheroe with a Sanders hat on. That's tips from Paul, Effie Zahos, Alan Kohler, our CEO, myself, and a few other people from our team. The bucket strategy I mentioned, there for those who are retired, it's a common investment strategy that a lot of them take and use the InvestSMART services for. And I've got a few other article links there as well. So now it's been very quiet on the questions front. If there's anything I haven't discussed here that you would like to discuss, please send it through now. But alternatively, you can reach out to me at m.snedden@investsmart.com.au. My colleague Tom was meant to be here as well with us today, but he was unavailable. But t.wilson@investsmart.com.au if you want to discuss bootcamp with Tom. He runs that. But yeah, thank you very much for joining us today. And look, I hope 2024 is a successful investing year, but and also if anyone wants to reach out to us and review, here we go. We do have a question that's come through. Can you explain the PMA value that's on my graph on my portfolio? Rightio. So when you are on your summary page, what you will be seeing is what you'll be seeing there. is essentially the dollar value that you've put in to your account versus the current market value of your account. So this is on when you first log into InvestSMART, on your summary page. You scroll down, you'll see a performance chart, and so it's the dollar value you've added over time versus the current value of that, and so you'll see the fluctuations over the long term. We anticipate that gap to really widen. Now, Anouk, I know in your instance, you came into InvestSMART in an unconventional manner through a stock transfer, and that can lead to sometimes that chart looking a bit funny because we need to write in the values, etc., of that stock. If that is the case, please shoot me a quick email. I'd be happy to get the team to look into it because we can fix that up for you. Great. I hope that's answered the question. Now, if there's any others, now is the time to shoot them through, because we're looking to wrap this up so you guys can get on with your day. As I said, though, if there's any questions, please feel free to make use of my email address there, and also email. You can start an online chat with me and the team. We're here to talk to you guys about your accounts and make sure that you're getting the most out of your InvestSMART experience. But if there's no further questions coming through, I'll wait a few more seconds. We'll look to wrap this up, and thank you guys for joining us. We'll be doing a lot more webinars well into the future in 2024. They're really important for us to reach out and communicate with all of our clients and let you know what we're thinking. And we love to know what you're thinking as well. So this will be the first of many in 2024. So I'll look to wrap it up here. Thank you, everyone, for joining us today, taking time out of your holidays, and we'll catch you again in 2024. Thanks. Cheers.